You're listening to A Deeper Dive, a part of the Winsight Podcast Network.
Is the economy headed into a recession, and how will that affect restaurants? Hello, I'm Jonathan Mays, Editor-in-Chief of Restaurant Business, and in this week's episode of A Deeper Dive, I speak with Michael Swanson, agricultural economist and consultant with Wells Fargo. Michael is a friend of the podcast. We have him on every so often to give us a picture of the economy, and he does not disappoint. We talk about a wide range of topics. That includes pricing and the outlook for menu price inflation versus grocery price inflation, and what that could do to industry demand. Menu prices continue to increase even as grocery prices show signs of slowing down. We also talk about the outlook for a recession, which seems to be coming at the moment, but so far does not appear to be resulting in any job losses, which would definitely affect restaurant sales. We also talk about the outlook for inflation in the economy and what could happen there. It is a great conversation about the economy, so please have a listen. I am here with Michael Swanson. Michael, welcome to the podcast, sir.
Pleasure to be back on. Always a great chance to visit about things.
Oh, yeah. So, all right. So as we sit here in April or May, gosh, I'm getting behind myself here. May 2023, where are we sitting at? What's inflation going to look like? Food inflation in particular going to look like this year?
Well, it's going to be a reversal of last year. First off, we're going to see the supermarket or at-home food inflation trend back towards that traditional kind of 0 to 2% range throughout the rest of this year. But we're going to see the food away from home, the restaurants remain high as they lag behind and start passing along those wages and other things. So it's going to be back to the traditional food away from home running at a higher rate than supermarket food. But it's going to be a big change from last year.
Yeah. I mean, we've already seen, you see that I've taken a look at I've obviously watched that close. Because last year was so unusual in terms of the gap, between the two. Retailers are really holding the line on price increases, and restaurants continue to raise them at a regular rate. And so, I mean, it's we're probably it certainly looks to me like we're a month or two from a flip where we're going to see a gap the other way around, and retail prices are going to be cheaper than restaurant prices, which will be an interesting scenario.
We actually achieved that in April. If you go back and look just marginally, where the at-home food inflation year over year was lower than the away from home. So it's just going to get more pronounced, to your point.
Yeah. Yeah. And then the question is how bad, how significant of a gap could that be? So you believe that restaurants will continue to raise prices at kind of the current rate? Is that just something that they always do? Or do you believe that we're just going to continue to see sort of these price increases at this rate?
Well, no, because what's going to happen is as that alternative food inflation at home falls faster than away from home, it's going to become more noticeable to the consumer. It's always about that balance of convenience and value, right? And so the consumer is certainly noticing when you go out to eat QSR or full service, it's expensive. And if they're worried about jobs, then they're going to think about, well, maybe I should change a little bit my habit, So it's always at the margin, but it's going to be more noticeable this year for the consumer. So it's that value proposition, and the bigger the gap between the food inflation away from home and at home, the more it's going to become a signal to pressure the restaurants to slow down as well.
Yeah. That's one of my concerns. One of my concerns right now, I'll tell you, is I have a big concern about the way the restaurant consumer is sort of being nickeled and dimed to death. And here's what I mean by this. If you go to a restaurant, if you've gone to like a limited service restaurant anytime recently, you might have noticed that you're being asked to tip now. So we're being asked to tip on a more frequent basis. And then you have these price increases on top of it. And then if you order delivery, you're paying even higher charges. So my concern really here is that is going to start looking awfully ugly. As you mentioned, you see it in the numbers. And I do all my grocery shopping, and so I know what those prices are looking like, and it's definitely noticeable to me that, consumers are going to notice that, and you have to believe that at some point that the consumer starts shifting, and if and that restaurants are going to have to start really holding the line on price increases.
You bring up a good point. I would call that the all-in pricing. We see that sometimes with some of the internet services. Say, I was recently traveling, so Airbnb, and you go through the selection, you look at the price, but until you book, you don't see their service charges, their cleaning charges, their room and boarding tax charges. And it's interesting. It's a little bit like the airline phenomenon as well. You can look at the airfare, but until you get the baggage fees and all the other fees put on top of it at the final click, you really don't know what you're paying. And so the all-in cost is very different than, hey, maybe the upfront on the window cost. And the consumer, after a few turns, will say, hey, I got to learn to play this game better. So, you're right that we've changed how we price the experience. And now consumers have to learn how that new pricing mechanism really does relate to the final price.
Yeah. In my I've always felt that consumers eventually adjust and figure things out and stuff like that. But I also went to 2 restaurants this weekend, each of which charged an excess fee that they didn't disclose beforehand, which is becoming increasingly common in the independent world, where they'll charge maybe a 5% healthcare fee, or like a 5% operations fee of some sort, or things of that nature. So you also have that. So when you dine out at a restaurant today, you're paying a far higher charge than you think you are when you set about doing that. And I think eventually is going to cause it's got to cause some challenges over time. Because the other thing, and we'll that's going to, which probably leads me to the next question, is we have a lot of economic uncertainty at the moment, and there's a lot of people that believe that we're probably headed for a recession right now. I mean, we're probably not in one, but it's certainly it's increasingly looking like the economy is starting to lose some of its momentum.
Well, let's talk about that. Today, this is Wednesday, May 3rd. So we're waiting for the Friday BLS payroll report, which is the first Friday of every month, typically, unless it happens to fall on Friday the 1st, then they push it back. But ADP, which is the precursor to that release, came out with a very strong employment gain number here. And the market was, like, when are we going to get this slowdown in payroll expansion that you would think would be caused by interest rate increases? And so it's kind of an interesting dynamic, because let's face it, for the most people, their most important economic asset is their job. It generates 90+% of their current income. And so until we really see that happen, now also we got out what we call the job openings and layoff report yesterday. And what did we know? Is we saw the number of open jobs crept down a little bit, but still a very high number. When you look at the number of total people in the labor force versus job openings, still extremely high compared to pre-COVID levels. And the quit rate is creeping down as well towards a more normalized. So the Federal Reserve is sitting here thinking, you know what? We still have a lot of job openings. We still have a lot of quits, and there's still a lot of jobs being created. Why would this be a recession? And so until we see that happen, it's interesting. Everybody's concerned. It's a nervousness that we should have. You might get blitzed. A quarterback has to acknowledge sooner or later you might get blitzed. And you got to have a plan for getting blitzed, right? Throw the ball away. But so far, we have not seen the opponent creep up on the line and show the middle linebacker coming around the side. So why not throw it deep down the middle?
Right. Yeah. That's. I love it when we use a football metaphor for economics. It's always great. But I mean, that's actually that's a very good point, because again, I just focus on the restaurant space, but like people, the thing is, like everybody, I think in the restaurant business is waiting for something to happen, because they see all these they see the economic data, they see the interest rate increases, and there were the bank issues, which tend to drive a lot of concern and things like that, and they think, well, okay, something is going to happen. And McDonald's has repeatedly said now for months, for instance, they see a mild recession coming in the United States, and they've been pretty consistent about it. But at the same time, to your point, people have jobs, and as far as I know, they still have money. They might be borrowing a little bit more, but on balance, they have money and jobs. And if they have money and jobs, they're probably going out to restaurants.
Well, let's talk about a couple of things. One thing is parts of the economy are already in recession, which is true at any point in time. For example, recreational vehicles, RVs, in recession. During COVID, people couldn't get into hotels, couldn't travel by plane, and there's cheap money. They got, incentives. They couldn't sell enough RVs. They couldn't make enough RVs. And it was beautiful. Right now, there's a real lack of demand for RVs and a surplus of RVs. How about e-bikes? During the COVID event, people wanted to have a economic activity outside. The supply chain was disrupted. You couldn't get an e-bike. I was recently in a market where they have 2.5 years of e-bikes sitting in their warehouse right now on current sales rate. So there are parts of the economy that are definitely in recession, but they were the parts of the economy that boomed during the disruption. And so maybe they're just going back to more normal times. So there's always that, and then going back to your comment about the jobs and things like that in McDonald's, it's interesting. Each person has to bring the value, and each of the QSRs or limited service restaurants have to bring the value. And we know, I'm not going to throw stones at anybody's glass house, but some people simply deliver a better value and have that. And there's a lot to discuss about looking at one particular company and what's it doing. So call a recession, worry about a recession. Wait a minute. Even during the Great Recession of 2008, we had 5% contraction in jobs. We didn't see spending on food decline. It went sideways, but it didn't go down. 1 out of 20 people lost their job. And that's not true. The people that lost their job probably lost their job multiple times, whereas most people kept their job, but they were nervous. So to sit there and to keep the weight on the back of your heels about a possible recession, instead of grabbing the bull by the horns and making sure you're giving the best dining experience to the person that's coming through the door today, that seems to be a kind of an interesting approach to marketing.
That's a really good point. And it's a really good point. We talked before that even through recessions, as you mentioned, like restaurants maintain they do pretty well. And I could tell you, as I look at the individual performance, and usually what happens in situations like that, the brands that struggle are brands that were struggling for a reason. And there's a reason why they were having issues. It's not just because, even during the pandemic, the brands that failed were brands, a perfect example is a certain, group of buffet concepts that basically shut down the whole thing. And they'd been struggling for ages. They'd gone through multiple bankruptcies. They didn't really invest in their restaurants and things like that. And the issues right now, even that we're seeing after the pandemic, is usually companies that just didn't have a good base. They have a lot of debt. They weren't very profitable to begin with. They're not really doing what they should with the consumer, and consumers react and things like that, and then they have subsequent problems associated with it. But on balance, people usually keep eating out in some form or fashion because they really like to do it. They might shift their spending a little. They might get, they might go towards cheaper options a little bit more, but they'll continue to eat out at restaurants.
Well, and it's interesting. You bring up a very important part of asset financing, whether it is restaurant chains or whether it's hotel chains or whether it is car dealerships. Sometimes we operate in the greater fool theory of the financing world. Well, things are going well and debt's getting cheaper. You believe, okay, even if I maintain this cash flow, there'll be a bigger multiple on that cash flow in the future for the sales point. And go back to the 2008, 2009 housing crisis. At some point, the greater fool theory fails you temporarily, and you have to struggle with that. And so you get a reset. And so whether it is restaurant chains, car dealerships, hotels, whatever, what the Federal Reserve's interest rate is really doing is saying to people, hey, you have to finance at a much higher cost right now on the debt. Therefore, the multiple has to be smaller, not bigger. And so you really kind of, to use Warren Buffett's famous example, when the tide goes out, you get to see who's not who's naked when they're swimming. It's not a pretty sight. And so it's, the higher debt is really kind of the tide going out of this greater fool theory. And so it's saying, hey, earn money by operations, not by betting on the come. A year later or 2 years later, you can sell it for a greater multiple.
Yeah, that's fantastic. So now the thing that we've been hearing actually really the last couple of weeks pretty universally is some real improvement or some real improvement in terms of inflation metrics and labor. In particular, labor seems to be getting easier to find. That's actually seems to be universal. I haven't talked to anybody. Nobody has mentioned, well, labor is getting tougher. Nobody's saying labor is getting tougher. Everybody is saying labor is getting better. People are staying at their jobs longer and things like that. So, I mean, it looks like to me that if you look at the operating environment from a restaurant's perspective, that this actually could be a decently profitable year, certainly compared with last year.
And in my most recent blog, which people can find on the Wells Fargo website, got to put the pitch in, of course. What I said is everywhere and always inflation's labor. To your point, that you just teed up perfectly. And so we were never short ingredients. We were never short corn. We were never short soybeans. We were never short strawberries. But we didn't have the trucking. We didn't have the factory work. But as labor force participation has recovered, and that's a big, big deal, we've seen wage rates come down, the growth rates. For example, in the service industry, we've seen last report was 3.5% year over year wage rate growth. That's very similar to what we saw pre-COVID. And so, to your point, they know how to deal with that. They know how to have a 2.5% menu board price increase and that type of labor as they work with efficiencies. They make it happen. So if they're back to that environment, menu boards are going to stabilize as well because their competition is going to make it happen.
Mm-hmm. Yeah. I also, one of the things I think we need to kind of remember, and I think that we probably needed to remember this last year maybe, is that a lot of what happened last year is just an adjustment to emerging out of this pandemic, where you just had this large number of people that changed their lives, or they weren't working, or they decided they were going to do something else, or they were just slow to get back into the workforce. Actually, that was quite a bit of it, I think. And I just think that, the economy was moving, demand was moving at a faster rate than than people's willingness to go back into work. And so a lot of it is, I don't think certainly in a generation, really, I guess the early 80s, you have to go back to any scenario in which you had inflation like this. But you have to go back a century since we had a pandemic of this scale. And I don't think any of us were alive at the time. If we were, we certainly weren't dealing with economics in the restaurant space. And so it was always made this thing tough to predict, but there was just this big adjustment from what's been happening, and people were naturally slow to get back to work because they didn't want to get sick.
Well, and let's talk about that for the restaurant trade, because it's interesting how the recovery is still proceeding. We're pushing people to try to come back to work from office, right? And a lot of companies have compromised 3 days in, 2 days off. And so we see this very interesting dynamic around the country. I travel a lot. Monday and Friday, the highways are empty as people are taking care of that, work from home dynamic. Tuesday, Wednesday, and Thursday, you see a traffic difference. But that's going to have an impact on where people eat, on that Tuesday, Wednesday, Thursday as well. And then each restaurant has its strength. Are you a breakfast? Are you a lunch? Are you a dinner chain? Do you cover them all well? And where's your locations? Downtown, on the periphery? Are you in the suburbs? And so the industry is still working with this, hey, what's the new pattern? And how do I staff for it? How do I create a menu for it? And so it's interesting. So it's not all done yet. We're still saying, hey, what's the new best way of doing this? But you see a very interesting. And so the restaurants very much feel this dynamic, and it's up to them to say, how do I respond to this dynamic?
Yeah. It's been, It's tough to make a decision in a climate like that because I think you had a lot of operators that are trying to make a guess as to, all right, what is this? Is this trend going to last over the long term? And you mentioned, that work from home dynamic. We're betting that people are going to probably work from home a lot more often for a lot longer. They're making this bet that people are going to continue to work from home at an elevated rate for a long time. And a lot of restaurants also are making a bet that people are going to be using the drive-through at a higher rate than, but it still makes it a difficult because you just don't really know how the consumer is going to react. Are they going to come back into the office? Are they, as far as how they're dining at restaurants, or they've been rapidly normalizing in that way. It does make the environment to try to make a decision in a situation like this to be a little bit more complicated because it's hard to see what is permanent and what is temporary.
Well, I have some advice then for people. So right on the back of your hand with a Sharpie, it's not about me, because what we're going to see, whether it's work from home or work remotely, is whether the companies make money doing it, right? So if you have a company that makes more money with remote workers because they're happier, they can pay them less, they save office space, they're going to go down that road. But if they start losing market share because they're not competing well with somebody who put the people back in the office. I was down visiting somebody in Des Moines yesterday, and it's 100% back to office because they just felt, we don't get the productivity from people when they're not in the office like we're paying them for. Now, it's going to be a question: who makes more money? If they do better than competition that doesn't force that, it'll be interesting. So it's not about me. So it's like I might like to work from home, but if my competition's beating me 6 ways from Sunday, while I do that, I might have to go back to the office. So we'll find out. Yeah. But it's not about me.
Companies are going to have to make a lot of decisions. That's going to be really one of those big, just obviously beyond the restaurant space. I mean, it does affect it nominally in some form, but like just back to, back to the office decisions and things like that. At some point your companies are going to have to force the issue, or they're going to have to exit their leases in some of these facilities. They're going to have to reduce the space that they use. So many decisions that have to do with that are going to have to be made here, because I don't think a lot of businesses can continue at the way they're going without making some sort of change. Right. And, you bring up the productivity issue, because you do have a lot of people that don't necessarily, you have a business in which people are more productive in the office. You might have to bring them into the office versus, things like that. There's just a lot of decisions that have to be made on that front for sure.
And as we go along, there's going to be technological change anyways. There's going to be competitive change anyways, regulatory change anyways. And so, there's no happily ever after in economics. That's something that we should always remind people. There's no happily ever after in economics. You can make the right decisions today and still have to make a painful decision tomorrow. So
yeah, super. Michael, this was fantastic. Really appreciate you joining me this week on the podcast.
Well, it's always a pleasure talking, and I hope your clients and listeners got something out of this conversation as well.
I'm sure they did. Thank you very much. And that should do it for this week's episode of A Deeper Dive, which was edited, as always, by Kimmy Kazmarek, artwork by Nico Hines. You may find this and other episodes of the podcast on our website at www.restaurantbusinessonline.com/article/deeper-dive. You may also find them on Apple Podcasts or Spotify. I'm Jonathan Mays, your host and podcast producer, and the editor-in-chief of Restaurant Business. Thank you for listening.